All right, we are live. Welcome back, investors, to Ticker Time News. I'm Adam, and last week ended on a bad note, didn't it? If we actually look at the weekly chart, I'm going to throw that up here. This is the S&P 500 in front of you. The ticker symbol that I use is SPX. Remember, you can use the same charts at home to follow along. There's a link in the description to TradingView. Sign up for a free account. Doesn't cost you a thing. On the weekly here, we actually made a new weekly low last week on Friday. And I did not notice this because the margin between the low that we made on the weekly on May the 16th and last week's low was actually a hair, just a hair lower. But this week, we are starting off with even worse news than what we did last week. I'll go back to the daily view here to look at this. We are starting this week making a new low for the year, not just a new low for the year. There were countless concerns in today's trading mix that drove the Dow Jones, the Nasdaq, and the S&P 500 to hit new 52-week lows for all of them. And the S&P 500, it went back into a bear market. Now, not just going into a bear market intraday and then popping out at the close. Oh, no, no, no. The S&P 500 is right now technically in a bear market. And remember, to be technically in a bear market, you have to be down 20% or more from your high, which would have been set on the close of January the 3rd or intraday January the 4th of 2022. And right now, the S&P 500 is down 21.3% from that point. That's not good. Today, if you were looking for capitulation in the market, you might have seen it over the past 3 sessions. We may have actually seen it. If you look here on the daily view for the S&P 500, and again, the ticker symbol for that is SPX that I'm using. Today's big decline, hitting a new low for the year, a new 52-week low, we saw that with a big uptick in volume. And to give you some indication on the volume uptick, it was pretty big. Last week, on Friday, I should say, we had 1 billion trades. And it wasn't that much over, right? But volume had ticked up higher. Today, though, volume jumped. And let me give you some numbers. For the New York Stock Exchange, okay, average volume was 1,054,000. That was the average. Today, the New York Stock Exchange in volume, 1.2 billion. 1.2 billion, with the average being 1,054,000. Now, at the Nasdaq, the spread was even more. At the Nasdaq, the average is 4.9 billion. But the volume at the Nasdaq today was 5.8 billion. So this big move today also came with big volume. That's people throwing in the towel, giving up, that saying, you know what, I'm out. This market is just too volatile. I'm losing too much. I'll come back later. That was today's reaction in the market. So if we're looking for capitulation, we may have either seen it or we're seeing the beginning of it. And it all had to do with the Fed, the Treasury market, and growth concerns. Now, the troubling, or the trouble, it was written on the wall, okay, for both the Treasury and stock markets. The Treasury market got clobbered on rate hike concerns, while the stock market got clobbered on a combination of rate hike concerns and growth concerns, like I said. But by and large, both markets got knocked out today with selling pressure. The 2-year. Let's look at that for a real quick moment. US 02Y is the ticker to look at the 2-year. The 2-year settled today up 23 basis points to 3.27%. It's even higher now in after hours, but not as high. It climbed to 3.43% following the close of the cash session. So right at 4 o'clock Eastern, when the Wall Street Journal released a report saying that the Fed could be considering a 75 basis point rate hike at this week's FOMC meeting, given the bad inflation report seen last Friday from the CPI report. Now, the Fed meets on Tuesday and Wednesday of this week. Wednesday is when we're going to have, we could see massive trouble in the market on Wednesday, because that's when Jerome Powell comes out and gives his press conference. And 30 minutes prior to that press conference, and that press conference usually is about 2 p.m. Eastern, 30 minutes prior to that, we'll get a press release that says what the rate hikes will be. Now, this could send the market into a free fall if we get that rug pull. So look at here at the 2-year. Look at how it's been trading inside this box for a while now, going all the way back to April the 18th, and then June the 10th is when it popped out. June 13th climbed even higher, and 13th is today. Now, the 10-year, US 10Y, the 10-year today. Adam, crypto to zero. Ah, that's a good one. I do have something interesting to talk about crypto as well today. And I usually don't talk about crypto, but I do have a little segment about Bitcoin and a theory and something that I've seen that I'm going to point out. Okay, so on the 10-year, it also spiked today. And the yield settled up 21 basis points to 3.37. It's down a little bit. It's down 0.1% from where it closed. So not much movement. Call it flat. However, when that same Wall Street Journal report came out about the 75 basis rate hike, the 10-year shot up to 3.34%. Now, what did we just hear? The 2-year, after that Wall Street Journal report, spiked to 3.34%, and the 10-year also, after that same Wall Street Journal report, spiked to 3.43%. That's the same. So the spread on the 210 went to zero today. And remember, when that goes negative, that has most always, I have to think back, I believe every time, at least in recent history, has triggered a recession in 12 to 16, 18 months from the time of that inversion. And it inverted, that yield curve inverted earlier this year. Today, the yield curve got to zero. Could it invert tomorrow or Wednesday when the Fed announces what they're going to announce? It's a possibility. That would be another worrying sign that a recession is coming, even though I think we're probably in one right now, and we just don't have the data to prove it. Now, after this, after the 210 went to zero, I'm trying to get my thoughts together here. There's so much to talk about, and I don't want to miss anything. I got my notes written down here. There had already been concerns about the Fed taking a more aggressive rate hike path. Yet the timing of the article and the source of the article lent some credence to the idea that the Fed could possibly, quote, surprise the market this week and give us a good old rug pull. Though that's not a given. They've said 50 basis points. That's what we're expecting. Everything else is speculation. It's intended to explain why there was some knee-jerk reaction, selling pressure late in the day, following that New York Times report. I'm sorry, Wall Street Journal, excuse me, Wall Street Journal report. Now, what I shared with our investors this afternoon was that this article is called a, quote, trial balloon. And I'll show you right here. I put it in, and I mentioned that in this section, so you don't think I'm pulling your leg, right here. The trial balloon. Now, it is meant to see how the markets will react to the idea of a, quote, surprise 75 basis point rate hike. So what I'm saying is the person who wrote the article may have been given knowledge by the Fed to, could you write an article for us? Or maybe the Fed wrote the article and gave it to this journalist. We want to do a test run, and we want to see how the market will react if we do a surprise 75 basis point rate hike after we said we will do a 50 basis point rate hike. So that's what this trial balloon is intended to do, to see the reaction. And the market reacted. Now, we know we had more volume today, so I'm going to take that off so we can see this a little bit clearer here. Look at where my question mark red circle was compared to where we actually got today. So the market came down faster than I was anticipating. Because, see, I was thinking that on Wednesday, we get a 75 basis point rate hike, and boom, that's what sends the market down this far. I wasn't expecting this article to come out and say that. Now, the initial reaction, we know, it was not good today. But the stock market is also desperate to see some kind of progress in slaying inflation. So, it might just be in a mode of seeing is believing, creating a certain setup. Now, I'm not going to share that setup here during the live stream. I shared that setup with our investors on Patreon, so I want to keep it fair. And since I sent that late in the day, I at least want to give everyone, all of our investors on Patreon, at least a day or two heads up on what I believe this setup that is being created right now. So, let me just plug it, and then we'll move on. To be fair, that's why I'm not sharing it right now. But if you would like this valuable information to help you along your investor journey, then come join us by clicking the first link in the description. We'd love to see you there. All right, let's get back into it. The stocks had already been struggling with the jump in yields, but they cascaded to new session lows, or a close to session lows in the final hour, in a move that coincided with the extra spike in Treasury yields following the report. Now, it was a fitting end to a day where most stocks were treated like punching bags. The body blows came early, then shot by shot with these influences in the market. I've got a couple of them here, or a few of them. Number one, worries about the Fed taking a more aggressive rate hike path to fight inflation, which I believe has a high probability that they will. Now, what they could do is do a 50 basis point rate hike, like they said, for June and for July. But what they could do is there's no meeting in August. So they could have a special emergency meeting and do another 50 point a 50 point basis rate hike in August with a special emergency session. They could do that. Or they could tack it on to June or July. Those are possibilities. But I think they're coming in and they're going to be more aggressive. How they spread that aggressiveness out, that's the big question. All right, number 2. Reports of renewed lockdowns, shutdowns in Shanghai. I know I say it every day, but it does have an impact on our supply chain. There were also rumors of shutdowns, lockdowns in Beijing due to the detection of new COVID cases. Number 3, a lack of confidence in valuations, given that forward earnings estimates have yet to be cut in any meaningful way. And we talked about this on Friday, despite expectations for much slower growth and or a recession in the next coming months, or potentially one right now. Then Bitcoin. Let's look at Bitcoin. BTC USD is the ticker. Now, I usually get the data from Coinbase, but today I'm going to Bitstamp, and the reason I'm doing that is because I have a special chart set up here for you to see for Bitcoin. And this is something that I'm going to go to the weekly view here for Bitcoin. This is something that in the Bitcoin market, it hasn't happened yet. And if it does, it'll be the first time in history that it's ever happened. Now, we know there have been massive losses from cryptocurrencies, coinciding with news that crypto lender Celsius has paused customer withdrawals. That means if you have your money in Celsius, you cannot get it right now. You're basically locked out. You cannot withdraw that money. And you cannot make transfers. So you cannot transfer that money to like Coinbase, for example, from Celsius to Coinbase. You can't do that. Now, they say this is due to extreme market conditions. However, if you dig a little deeper on this Celsius news, you'll realize that a few days ago, a week ago or so, they said there was nothing to worry about. So were they lying to us then? Because then, a few days to a week ago, Celsius told all of their users that, wait a moment, hold on here. We have plenty of Ethereum. We have plenty of money. So if people want to make withdrawals, they can make withdrawals. Well, BS. Because now you've stopped people from making withdrawals. Now, the thing that has never happened to Bitcoin before, okay, never, ever happened, is this. You know, every 4 years, there's a halving event with Bitcoin. It means that there are half as many Bitcoin that can be mined during the next 4 years. Then it's cut in half again, cut in half again, cut in half again, until the very last Bitcoin is mined. And at that point, there will be 21 million Bitcoin in the market, and that's it. Won't be a single Bitcoin more. So during these halving cycles, every time there's a big run up, then there's a pullback, a base is built, and then there's a run up, a pullback, a base is built, a run up, a pullback. That's where we are right now. We have not yet gotten to the stage of building that base for the next launch pad. Now, let me show you this. This is very interesting. From the very peak of the first one to the bottom, the pullback after the peak was 420 days and 84.3% drop. Okay? So the peak, the very first here, peak of Bitcoin to the first big pullback after the halving, it took 420 days and we dropped 84%. All right, that's interesting. Let's go to the second one. We have our peak in Bitcoin price after the second halving to our bottom. The pullback after we reached the top was 420 days. Sounds similar? Because it's exactly the same. 420 days for both of these. The pullback was 82%, 82.1%. So during the first halving event and the second halving event, from the peak to the pullback after the peak before slowly creeping up and then the next rally, took 421 days from peak to bottom, and 84% the first time, 82% the second time. Guess where we're at right now today? Right now today, from the peak to the bottom, 420 days. 420 days. We're only down 62%. We're not down 82. We're not down 84. Now, I want to make a change here, okay? Because there were two highs, unlike the first two, where there was a definite peak. There was a second peak for Bitcoin. Remember, it was in November that got us a hair bit higher than we are right now, okay? So if we do this, I've got it there now on, or in November, we're going to go 420 days, 420 days, and we're going to go down 83%, because that would be in the middle of 82 and 84. Keep it on 420 and go to 83. It looks like the closest I can get to 83 is 82.99. 420. Okay, so now, if this is the case, all right, if it takes 420 days from the peak to the trough or the bottom before we start building a base and going up again, and we pull back 83%, which is in between the 82 and the 84% the first two times, that would put Bitcoin at $11,000. I'm thinking here $11,700. If the first two halving events are to be copied and pasted to the third, and I know there's more awareness in Bitcoin right now than there was during the first halving and during the second halving. So maybe it doesn't fall 82%. But if it keeps the same 420 distance, that would mean December of this year is when Bitcoin will hit its low. And again, that low is right about 11,700. Now, what would be the first time if this happened? What would be the first time? What would make this the first time? Well, for Bitcoin, during the first two halving events, once reaching the peak and then pulling back, that pullback never dipped below the prior peak. So the prior peak for Bitcoin right now is a high of 19,200. 19,600. All right, so 19,600. Remember that number, 19,600. I'm going to go now back over to my other Bitcoin chart, BTC, USD. Remember that 19.6. And Coinbase. And again, remember that 19.6. Right now, Bitcoin is trading at 23,380. All right. I'm going to take this off the weekly and I'm going to go to the daily. And I'm going to open this up. Oh, not too far. I actually have to squish this together a little bit. Remember for Bitcoin, I said, we talked about this back here way back here, the middle to end of May. You can go watch the live stream. I said it, that I thought Bitcoin was going to break under $20,000. Maybe the floor would be around $15,000 or $16,000. Well, if 19,600 ends up being the low, because that was the previous high that was made for the halving event, that wouldn't happen until December, because it's been 420 days each time. Well, December the 1st is right here where this vertical line is. So that's a long ways away. And Bitcoin is only $2,500 away from breaking that $20,000 area that I predicted that Bitcoin would break. Now, if Bitcoin is going to $11,700, if it's going to do another 82 to 84% drop, let's see, 11.6 would be right here, this blue line. What do you guys think? I don't know if what I've put together here for Bitcoin is going to be the targets, or like you say, crypto to zero. My honest take, I don't think Bitcoin is going to zero. I think there will be a ton of altcoins that do go to zero. But I don't think Bitcoin will. I think Bitcoin is in for a big drop. And remember, 82 to 84%. That's what the pullbacks have been after the peaks for the first two halving events with Bitcoin. So why should we expect anything different this time around? Well, I don't think we should. I think once Bitcoin gets to those levels, 82, 84, maybe even go 80 to 85%, that's where we will build our base. So just to recap here, 11,700, that is the target for where Bitcoin should fall. And it should take 420 days to get there. So by going with the peak there, oh, it's a little difficult here to get this right because it wants to move so much. All right, so we've got 84% and 420 days. That puts us about $11,000 in the end of December. So could that be where we're headed? Now, I'm going to go ahead and I'm going to add this to our trying to get this lined up here. Doesn't line up perfect. Oh, did I not get it? Give me one quick second. I'm adding this on here to keep it here. 69,000. All right. And we're going to go 420 days. And I'm going to stop at 83%. All right, 420 days, 83%. So now that's going to stay there, that blue box. So I'm going to clone this and I'm going to put it down here because this is where Bitcoin could be going. If Bitcoin continues to follow the same pattern from the first halving to the second halving and now the third halving, this is where it should find its base. Okay? You guys agree or disagree? Let me know in the comments. What do you think? I know having two things does not make a pattern. Even with technical analysis, when we draw a trend line, we need 3 or more points of contact for that trend line to work. We've only got 2 halvings to judge off of, right? So if this halving follows the same pattern from the first 2, then we should be looking at Bitcoin building a base right around 11,000 at the end of December or the beginning of January, right? And then from that base, it launches off again. What do you think? What do you think? Let me know. All right, let's move off of Bitcoin here. I took a little extra time than I wanted to talk about Bitcoin. And just so you can see Ethereum, both of them are bouncing in the after hours here from these big drops today. Look at Ethereum, $1,215 right now. But both of them are making a bounce from these levels. You can see a small, very small green candle forming here. This is the daily view. So we got a new green candle forming for tomorrow so far. Can it hold? I don't know. Okay, now we were talking about the different things that were affecting the market today, right? The influencers for the market. Bitcoin was number 5. It sinking because Bitcoin, you can look at it as a speculative, a risky asset. And today's move in the market was risk off. That point, very easy to understand. All right, another influencer for today was general growth concerns that were tied to rising interest rates and the flattening yield curve. That also counted. Another influencer, nervousness. Nervousness about forced selling due to what is a forced sell? Margin calls. How many people in this market got margin called today? And that's why we had this accelerated push. I mean, look at the gap down from yesterday to today. That gap down is significant. Look at this. This big hole right here. That gap down from yesterday to today. Margin calls. People being nervous about margin calls because that can send the market into a free fall, and capitulation can happen during those times. Okay. So those are like the 6 or 7 things that influenced the market today. Now, the advance and decline line told the tale of a market lacking any strong buying interest. You ready for these margins? Declining stocks outpaced advancing stocks by a 16-1 margin at the New York Stock Exchange. That spread was 23-1. That means 23 orders were sell for every 1 buy order shortly after the open today. So it slowed off as the day went on. So right at their opening, a burst of selling activity. And then by a 7-1 margin at the Nasdaq, and that spread was 11-1 shortly after the opening. These are big sells to buys. That is, or that I should say, that equates to some very steep declines. And with all that selling came all 11 S&P 500 sectors closing with losses that ranged from down 2.2% consumer staples to down 5.1% energy. Yeah, the energy sector did not look very pretty today. Let's pull up our sectors and we'll go to energy, which I believe is the bottom one. Here's the energy sector. Remember our risk reward profile? Energy had popped out of its trading range. And usually when it does that, you see a pullback, although this was a pretty steep pullback. The last time we had a steep pullback like this would be the big pullback on May the 9th, but a multi-day pullback, like a cascading effect like we had here, would be April the 24th, 22nd, and 25th. Now the 25th, there's a big wick at the bottom, much like today, there is a pretty substantial wick at the bottom. There is no wick at the top. This is like an ice cream cone wick or a popsicle wick where you've got the wooden stick and then the popsicle on top. Now, this is showing some buying interest coming in, stepping in for energy. Now, 9 of the 11 sectors fell at least 3%. The Vanguard Mega Cap Growth ETF, which I love to look at, that's ticker symbol is MGK, that dropped 4.5% today. That's a pretty big drop for an ETF. It is now getting close to its support. Okay, now let's compare this Mega Cap Growth down 4.5% Let's compare that to the Invesco S&P 500 equal weight. The ticker symbol is RSP. How far did that drop today? Or did it? It dropped 4%. That shows you it was a broad-based selling that happened in today's market. I think that's pretty self-explanatory, right? I mean, everything was in red. Just about. Now, the Russell 3000 growth index, that declined 4.5%. But the Russell 3000 value, that declined 3.8%. So even value stocks got hit. Now, to sum up today, it was a day where nothing worked, except some individual stocks with company-specific news catalysts, like Duke Realty. Ticker symbol is DRE. And it's loading, and there it is. It was up 1%. I know, not a big gain. But in a market full of red, it was a nice gain. And the reason I bring this up is because it was a very specific reason for why Duke Realty was up, and that's because it's being acquired by Paralis, or Prologis, maybe. Not quite sure how to pronounce that one. And it's a $26 billion deal in all stock. So at least there was something green. There was something else green today in the market today too. And that would be anybody shorting the market. Now, if you've been following along, you know that we like to play inverse ETNs. Think of them as an ETF that are inverse whatever it is they're tracking. So, tracking the S&P 500, that would be the SPXS. And that's where I was holding over the weekend. And that was up 11.5% today. Not too bad. And they have these inverse for the Qs as well. So if you're not just using SPX, if you're using SPY or Qs, you can use, there's a whole bunch of them out there. For the Dow, for example, there's one called UDOW, UDOW, and that is shorting basically the Dow, but you're just buying it like an ETF. You don't have to worry about options. That's why I like these. They're easier. Of course, they are more limited than options, but they're pretty easy to follow. For the Nasdaq, you've got TECS, and that will take you to the Direction Technology Bear 3X shares, and you can see that skyrocketed today, up nicely, 13.2%. So there's a ton of these out there that you can use. Small cap one, it did incredible today. The ticker symbol is TZA. Direction Small Cap Bear 3 times shares, and that also just popped again over the past 3 sessions. They've all been rallying good. This one was up 14% today. So there are some that you can find out there. Oh, what am I drawing? I don't know. So there are some ETNs out there. You know, they act like ETFs, but they track something very specific and in an inverse correlation or an inverse way. So you have those that you can use at your discretion to beat this market. Now, reflecting the nervous state of the market today, the volatility index, VIX, VIX, that did some surging today, if I should say so. 23.9%. And it settled down in the after hours down a little bit to 22.6%, and it's at 34.03. Now, I pulled up the wrong VIX here. It's the one that doesn't have my markings. CBOE That's the one you should use. And this one has my drawings on here. All right, so over the past couple of years, whenever volatility has gotten into this range up here above 33, it has reversed itself and gone down, which means the market has gone up. And that should give you a little clue to what I told our investors on Patreon in that note. So I'm going to say, all right, there was no economic data out today, thank goodness, because that could have sunk the market even more. But looking ahead to tomorrow, we're going to get the May NFIB Small Business Optimism Index, which I'm sure that's going to be gloomy. And then this one's important. At 8:30 in the morning, we get the May Producer Price Index. That's the PPI. Now, the CPI is the Consumer Price Index. It's what we pay when we go buy something at the store. The Producer Price Index is what Walmart pays when they buy something to put on the shelf. The Producer Price Index is actually looked at closer by the Fed than the Consumer Price Index. Okay? So this is going to be a big deal for helping the Fed to make their decision over their 2-day meeting. Okay? All right. I hate myself for taking profits on my 380 SPY puts on Friday. I would have been up for, oh my goodness. Wow. Yeah, that's why I held my positions over this weekend. I'm not expecting good news this week. Although, when a market gets oversold, a market can bounce. Keep that in mind. I kind of rolling the dice to hold from Friday to Monday, but I just wasn't really confident that if we saw any bounce today, that it would be significant. That's why I held my SPXS position over the weekend and through today. It was a tough call, but you know, sometimes you win, sometimes you don't. I mean, that could have easily gone in the opposite for me today. And what you did was a very smart, calculated decision. Take profits when you have them, because there may come a time when you've got a profit, and instead of taking that profit, you hold, and then you end up losing that profit. So that's an important lesson, and you actually, I think you made a better call than I did. Just don't feel bad about what you could have had. Feel good for what you have. But I get you there, man. It would have been nice to have that extra 40 plus K rolling around. Absolutely. Because the more you have, the more it can work for you in the market. So, but you made a good decision by taking your profits when you had some. Definitely made a good decision. So don't dwell on it too much, because you did a good job. Very proud of you. That's a really good decision. All right, PPI, again, the Fed's going to pay close attention to that. So just know that. We'll talk about it when that comes out tomorrow. A note will go out for our investors on Patreon. So again, if you want that information to help you along your investor journey, just click the first link in the description and join investors just like you and me over there. Ton of valuable information. One more thing that I want to end on, and it's like a cautionary tale, okay? The EV market, the solar market, the renewable energy market, There are a ton of startups in this area. Some of them are going to do great. Look at Tesla as an example. They're doing great. Not all of them will do great, unfortunately. And we can go back in history and see how this plays out. Look at the early innings on the automobile industry. Henry Ford. There were hundreds of car manufacturers. Much like today, there are many EV manufacturers, EV startups, electric vehicle startups. Some of them are going to fail. One of them has already failed. I give you Electric Last Mile Solutions. Ticker symbol is ELMS, ELMS. They were going to manufacture buses, school buses, transportation, city buses that were going to be electric. They filed for bankruptcy today. The stock plunged 61% during the day, leaving the company with 19.5 cents a share left over. It opened today at 24 cents a share, but this thing had reached a high of $12 after this was a SPAC deal. So remember in 2020 and 2021, all those SPAC deals and all those, think of Workhorse. This one failed. It plunged 51% in the pre-market today and then drifted lower by another 10% during the day. So it filed Chapter 7 bankruptcy, I believe it did. They had their board of directors hire a whole brand new leadership team back in February of this year who reviewed all of their products, services, their plans, how they were going to get it done, but ultimately they couldn't come up with enough capital to sustain their venture, and now they're gone, right? Bankruptcy. So just take this as a thought process to make sure you're evaluating your speculative stocks and you keep a close eye on them, especially for any news, because the news about bankruptcy can really hurt a stock, right? But it didn't just hurt this stock. It hurt other electric vehicle startups also. Made their stocks go down because people are getting nervous about, this is a speculative play. And then, a speculative play, it's okay in a bull market. But in today's climate where we are not in a bull market, we are in a bear market, it can hurt a little bit more. So just take it as a cautionary tale to make sure you're checking and rechecking your speculative stocks. And again, it's okay to have them. Sometimes those can be great big movers, but don't make them a cornerstone of your portfolio. Just keep them in a area that is real close. You got a careful, watchful eye over them, and don't let them get away from you. And also keep your position size relative to the phrase in investing, right? Don't invest more than you're willing to lose. Well, speculative stocks like this, you could lose a lot. So small position size is always a good thing. All right. That's everything that I wanted to cover today. So before I jump into any questions you have, let me just say that if you did learn something today, then do me a favor and click the like button, click the share button, and if it's your first time watching, click subscribe. And if you like this perspective and you would like more content to help you along your investor journey, then click the first link in the description and join investors just like you and me. Ton of value over there. All right. Anything that you guys want to talk about? I'm sorry. Let's pull this one up. A lot of people bag holding a lot of SPAC stocks. Yeah, that is true. But this is one of the reasons why. Now, I think, to your point about people bagging on people that hold SPAC stocks, I don't have a problem with it. I don't have a problem with speculative stocks either. You just have to make sure that you watch those a little bit more carefully than you do some of your other mega cap holdings that you may have, because they can get away from you real quick. But there's some that make it and do a good job, just like in the IPO market. Let's see here. Do you see the PPI numbers coming in hot? Yes, I do. Consumers paid a lot of money this past month. For the consumer to pay a lot of money, that means the product prices were elevated too. You cannot get high consumer prices unless there are high producer prices. At least that's a rule that I use when thinking about the CPI and the PPI. So I think it's coming in hot. How hot? I don't know. Because I did not think CPI was going to come in a whole 1% higher month over month. I didn't think we were going back to March inflation, but we did. So I do think it's going to be hot. I don't know how hot. But when it comes out at 8:30 in the morning, see, we always learn from our mistakes, or we learn as we do. When the CPI numbers came out, I took the time to write a piece about the market and included CPI. What I will do tomorrow for all of our investors on Patreon is when the numbers come out, obviously you can have the site open as well and watch. But when the numbers come out, I'll give you the quick take. I'll post the quick take, and then I'll post my longer pre-market piece a little bit then later. It comes out at 8:30, so probably 8:40-ish. I should have a post over for investors on Patreon, just a quick take on PPI. And then I'll have the longer pre-market piece that includes the PPI numbers with them a little bit later, like maybe 9 o'clock-ish. That's my time frame. So I'm going to break these important numbers up so you get them quicker and a quick take on them much quicker. That's something I learned from doing the CPI this past last week on Friday. So hopefully that works out better for you guys as well. If the Fed, let's see here, if the Fed doesn't do a 75 basis point rate hike and does a 50, Do you think the market likes that or sells off seeing that the Fed is a joke? Well, I like your quote there. The Fed is a joke. The Fed, in my view, has lost all credibility when it comes to inflation because they are behind the curve. They should have acted on inflation last year, not waiting to this year to do so. Now, if the Fed comes out and does its 50 basis point rate hike, I think the markets will like that. And I think the markets will act kindly to that. I don't think the markets are really, I don't think the markets really care too much, at least, going up or down based on the credibility the Fed has in fighting inflation, because the Fed's already lost its credibility to fight inflation. So that's, how should I characterize that? Maybe that incompetency has already been priced into the market a bit when it comes to that credibility. So, just to sum that up, if they only do a 50 point hike, they say nothing else, or they confirm that, yes, next month we'll do another 50, and then break in August because there's vacation, and then September, maybe they confirm a 50 in September. The market should like all three of those because that's basically what the market has thought. Today's drop-off was because there was this, let's throw this information out and see how the market reacts to a 75 basis point rate hike. So the market fell, obviously. So if that is not done, the markets will like that. And again, I don't think the markets at this point care about their credibility because the market's priced in that they have lost credibility and inflation. So I hope that helps to answer your question there. I like your on point there about it being a joke, right? Because they should have acted much sooner. Okay, so I think I can take the question mark off here because we're already down at those levels. Where shall we go tomorrow? A new low? A new 52-week low? That's possible. Okay. Any other questions? Otherwise, we'll wrap up this live stream. Don't want to keep you too long. I do greatly appreciate everyone being here, you spending your time with me. Hopefully, you have learned something to help you better understand this crazy market, because it can be for the birds sometimes. All right. So tomorrow, the producer price index is going to navigate or be the guiding star for where we go tomorrow. Obviously, if that thing comes in hot, we're going to go down. How much further down, I don't know, because we are really close to this trend line here. And if we break that trend line and go underneath it, then I think we're really starting to see capitulation. And if that's the point, if we're seeing capitulation and people throw in the towel and give up and quit this market right before the Fed does their rate hikes, then the Fed may just go all in. We see capitulation now, the Fed may just go all in and raise rates. 75, maybe a full percentage point. Why wait another month? The market already quit. Let's just do it. Paul Volcker, right? Let's see. If Biden announces pipeline reopen, that's all. That would be a big, big news. We didn't look at oil today. Let me pull oil up here for you. If Biden announced that the pipelines were to reopen, oil prices would drop. They would drop. Otherwise, there's no way to catch up high inflation. You make a great point right there. Capitulation, is this, I'm starting to think, sorry, I didn't see that capitulation question there. So yeah, with energy, pipeline opens up, energy comes down, inflation will come down, because energy affects everything. I mean, energy, oil specifically, it literally touches everything. And the world runs on energy. We need energy, and oil is one of the big drivers of energy. Okay, capitulation. Is this it? I would say today I'm starting to see what could be viewed as capitulation. Yes, absolutely. I'll go back. I'll go to the SPY on this one. When you have a sell-off like this, and let me take volume out. We know volume was higher today. Okay? Volume, all right. Volume was higher today. We know that. And to see capitulation, you need volume to come up, and you need the market to come down. And you need it to come down fast, because you need margin calls to happen. You need people's stop losses to get triggered, all because, and it's like a cascading effect or a chain reaction. And if you look at the SPY, boom, boom, boom. That's what we're getting right here, the past 3 sessions. So to me, yes, this is looking like the start of capitulation. This could be it. This could be what we've been looking for to call a bottom, or to say that we're near a bottom, right? If we use this, I'm going to go to the weekly here on the chart. Now, you would think that maybe, oh, the 7-week fall that we had here, well, maybe that was, no, that's not capitulation. Capitulation are big moves. Look at this weekly candle last Friday to today's Monday candle. That's a big drop. We have not seen that weekly drop all year. Nowhere this year have we seen a drop like that. There was a drop right here going into May the 9th. But that drop was not as big as this drop. So this could be the very beginning of capitulation. Now, if I bring this together, we're going to go back to March of 2020. And again, weekly candles here. Look at the big drop for the weekly candle, and then the week drop. This is capitulation right here. You have this first big weekly drop. The week closes, and then the week opens, and another huge gap down. This right here is capitulation right there. So that's what you'd want to see on weekly candles for capitulation. And let's go back a little further in time. Okay, this is 2011 to 2012. You have not really a big drop, or I should say not a big gap down, but there was a small gap down at the end of the week. Just a little tiny one down there after a big weekly candle fall. But I really wanted to go back to the 08, 09, 07. See, here's another capitulation move right here. Big moves. That's what capitulation is. Big moves. You have people throwing in the towel. I quit. I give up. I'm out of this market. You have stop losses getting triggered. You have margin calls happening. The market is just basically on fire. My screen is starting to lag again. Okay. All right. Well, good thing we're wrapping this up then. It could be lagging right now just because I'm moving the chart, and it does lag a little bit on my end on TradingView when I move it into when I try to move it quickly to go backwards in time. So now hopefully we are out of that lag phase. All right. Well, that's everything that I wanted to cover. Like I mentioned 15 minutes ago, but I can just keep talking, can't I? All right. Well, if there's no other questions, watch for PPI information coming out tomorrow just after 8:30 in the morning, 8:30 Eastern time, that is. So on the West Coast, it's a little bit earlier. What's that? 5:30 on the West Coast. 8, 7, 6, 5. Yep, 5:30. So real early. And yeah, that's the big thing. That's tomorrow. And then Wednesday, the big thing will be the Fed. Lovely. Okay, well, I hope you guys have a wonderful evening. Remember to do me a favor and click that like button. Share this video wherever you can. Both of those things help out a small channel like this. Subscribing, if it's your first time watching, that helps a small channel like this. And if you like this information and you want more of it to help you along your investor journey, then click the first link in the description of this video. Love to see you there. And with that said, you are welcome. And I will see you tomorrow after the market closes. And you'll see my words earlier than that. And you are welcome. Also, I am glad that I can do this. Absolutely glad that you are here too. I appreciate each and every one of you. I really do. And with that said, we'll wrap it up here, and I'll see you guys in the next video.